You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I think we hit bottom probably in February, but the big question is where we go from here. And I don't think we're going to bounce back to the previous highs that we've seen. In fact, I'd be surprised if we went back to those sort of levels within the next 5, 6, 7 years.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Matt Fernley of Battery Materials Review. In this interview, you will hear about the factors affecting lithium pricing, whether we'll see bifurcation in nickel pricing, is graphite still next in terms of bull markets, and where Matt sees the best value in the battery materials market today. Matt, it's great to have you. Let's start with lithium. The lithium carbonate price is down dramatically off its high. Have we hit bottom in terms of pricing?
I think we have. I think we hit bottom probably in February. But the big question is where we go from here. And I don't think we're going to bounce back to the previous highs that we've seen. In fact, I'd be surprised if we went back to those sort of levels within the next 5, 6, 7 years. And that has sort of taken a little bit of momentum out of the stock market for lithium stocks. I still think that there's money to be made in the lithium market, but I think it's going to be much more of a trading market than perhaps it was over the previous sort of 2 or 3 years or so.
So what are those factors that are, I guess, working against the market in terms of pricing? Like why is this level kind of the level ground we're at?
Yeah. I mean, I think realistically, I've said this a few times, but over the course of my career as a sort of commodities analyst, certainly since China spread onto the scene in sort of 2002, 2003, it's worked to be long of those materials in which China is short and short of those materials in which China is long. And 3 or 4 years ago, China was short of lithium, but it's not so short anymore. And that's what's really sort of come out of left field and pushed, what we're expecting from the lithium market in the next few years, sort of into a different environment. So what we found, what's come up over the last 2 or 3 years is, first of all, the Chinese have circumvented the block on Chinese investment in sort of North America and in Australia by investing very heavily in hard rock lithium in Africa. And that's a very quick development schedule, much quicker than a brine operation in Latin America. So they've been able to get that into the market very quickly. And also that they've invested a lot of money into their own lepidolite hard rock assets in China. And that's a quicker steel operation. So they've been able to really get those operations into the market in 12 to 18 months. And that's basically providing a cap in terms of lithium prices. So in in Africa, they managed to get some stuff on, but they can't probably get a lot more on because of the infrastructure cap. But in China, they're not capped by infrastructure, and they're not capped by capital availability. And as a result, they've brought this stuff on that was deemed to be very high cost, but at the current lithium prices, a lot of it's economic. And that's what's really changed the situation in the lithium market in a way that we didn't necessarily foresee happening. And a lot of that comes around because probably, 10 years ago, if you talked about bringing on a lithium operation, you were talking about bringing on a lithium brine operation in Latin America. And it takes a long time for these assets to come into production. And there are a limited number of them. But what we found increasingly over the last 5 or 6 years is these lithium-bearing hard rock operations or assets, they're not rare. And, they exist in China, they exist in Africa, in Western Australia, in Canada, in the US and elsewhere in Europe and South America. So they're really all over the world. And now it becomes a situation in the lithium market where it's not about finding lithium the way it was over the last 2 or 3 years. It's about finding enough lithium at a reasonable scale and reasonable mineralogy that you can make it into a mine. So the goalposts have very much changed from desperately, we've got to find lithium to, we've got to find lithium that works. And if you're looking at hard rock, for me, in terms of assessing lithium projects, it's much more like a bulk material now. So I look at lithium hard rock projects much more like I would look at an iron ore project with those lenses on. And I think that helps me as an investor evaluate the projects that I want to invest in, as opposed to what I regard as the also rans. So I think that's really what's happened in terms of exploration has really changed the goalposts.
Right. And so you mentioned, I'm probably going to mess this up, lepidolite?
Lepidolite, yeah.
And so that's another lithium-bearing mineral.
Yeah. So if you think about sort of lithium occurrences, so obviously there's the brine deposits in Latin America, which everybody knows about. And then there's hard rock lithium, and there's different types of lithium-bearing minerals. So the most commonly mined are spodumene. So in Western Australia, in Eastern Canada, those are spodumene-bearing rocks. But there are other types of lithium which maybe have lower lithium occurrences in situ. And lepidolite is one of those. Zinnwaldite is another one of those. And these have been regarded as sub-economic over the last sort of 10 to 15 years. But obviously with lithium prices going as high as they did over the last 3 or 4 years, they've not been sub-economic anymore. And basically the Chinese and other developers have found ways of effectively bringing these deposits into production economically. To be fair, when it comes to lepidolite, really, shall we call it Chinanomics, makes lepidolite assets viable in China at current prices. Lepidolite assets outside China are probably on the borderline of economic at current prices. So you need prices a bit higher to bring lepidolite assets outside China into production.
So if we say that the lithium price is going to hover around this level for, let's say, the next few years, how does that affect brine? I guess it's the price curve I'm talking about, because it seemed to everything was about seemingly hard rock lithium sources in this latest boom, or at least from a company perspective. With this current price, does that affect the cost curve, and what is more appealing in terms of hard rock or brine, or is it kind of a smorgasbord of choice?
Well, I mean, at the end of the day, if you wanted to bring a lithium asset on into production, you go brine. You know, if you have a choice, a high quality brine asset or a high quality hard rock asset, you go brine, because brine is right at the bottom of the cost curve. If you go with the evaporation methodology, that's bottom left of the cost curve. But in terms of ease of discovery, then you're going to go hard rock, because hard rock lithium assets are much more common around the world. You know, you don't need these very specific sort of salar occurrences in Latin America to find a hard rock asset. As I said, they're pretty much anywhere where there's been an active geological development, a lot of igneous rocks and greenstone belts. So, you know, practically anywhere in the world you can find pegmatites, which are what these sort of lithium occurrences are found in. And then in many of these places, you'll find lithium enriched pegmatites as well. So, if it's a question of the cost curve, you go salar brine. If it's a question of ease, you go hard rock. And then obviously there are other types of deposit which are more experimental rather than commercial, like sedimentary, which has proven up very well on a lab scale, but not yet on a commercial scale. And then obviously DLE brine as well. And again, that's unproven on a commercial scale. So at the moment, the only two vanilla techs in the industry are salar brine with a reasonable concentration and hard rock, again, with a reasonable concentration.
Right. And so if DLE is direct lithium extraction, if it's successfully proven on commercial, my understanding it's very much a case-by-case basis. Like, it's not a blanket statement, especially for the brines. But could DLE be that thing that makes the brines totally eclipse the hard rock landscape? Because that's sort of the analogy that I've heard, that if DLE is successful, that it could wipe out the hard rock case.
I mean, certainly that was the perception, that has been the perception over the last 10 years. I think one of the things that comes out very clearly from a lot of the work that's being done on DLE now, and certainly has been done over the last 4 or 5 years, is that DLE is more expensive than perhaps we perceived it to be initially. So if you look at the companies that are doing DLE developments in, the southern part of the US, Western Europe, etc., these sort of projects, you'll find that the capital cost of these projects has crept up quite considerably from the preliminary economic assessments up to the situation where these guys are in feasibility studies and perhaps in engineering studies, often by a magnitude of 2 to 3 times from the initial estimate. And then the operating cost has also crept up. And you said it's on a case-by-case basis, and it genuinely is, because, in each different ore body, you'll find that the water is at a different temperature. There are different impurities in there. So, one DLE technology, like, for instance, ion exchange, may work very well in one asset, but really badly at another asset. And what we found also is that even though the residence time in the column is much quicker than it is in evaporation in a salar brine, to make the residence time economic, you have to put quite a lot of water pressure through there. So, and that's power intensive. So what we found is that the initial assumption was that DLE would be a bottom quartile technology, and increasingly now it looks like being a second quartile technology. So not uber expensive, but obviously factoring in the capital cost, which effectively takes out most juniors in the space, because most juniors have sort of 100, 150, maybe 200 million market cap, and the capital cost could be up around $1 billion. And then the operating cost, you have to have quite a large checkbook to develop a DLE project. And that's why we find a lot of the oil companies looking at DLE at the moment.
Oh, interesting. When it comes to this sort of price level for lithium, how does it compare to alternatives like LFP? Does this price level make lithium batteries that much more appealing? Like, I know there's more components, but how does it compare to LFP right now, who I believe like a year ago would have been like the low cost choice?
You mean like sodium ion? How does it compare to sodium ion? Yeah. So at the moment, with lithium prices as they currently are and cell prices as they currently are, sodium ion is not in consideration. So basically, the collapse in lithium prices has taken sodium ion entirely out of consideration. There's no need. Sodium ion is less energy dense. The supply chain is not developed to any great extent. So if lithium prices stay around current levels, and lithium ion battery prices stay around current levels, then there's probably no need to develop sodium ion as a solution. Obviously that's positive going forward for lithium ion demand. And then, in terms of the differentiation between LFP batteries and ternary batteries, to some extent, the differentiation has closed down a little bit, because obviously you've seen nickel, cobalt, and manganese prices at multi-year lows as well. So the premium for NCM or ternary batteries has really shortened. It's really become thinner. Yeah, so the premium has really closed down. But I'm not convinced that nickel, cobalt, and manganese prices will stay at this level forever. So I would expect the premium for NCM to open up at some stage. But certainly, if lithium prices stay pretty depressed, then I would expect LFP batteries to continue to be very economic for EV manufacturers and ESS developers as well.
Right. And I think that's the perfect segue to talk about nickel. It's got to be one of the most interesting markets right now, I think, for what's going on. Indonesia has really pushed ahead and come on as the dominant player in the nickel market. And really what we've seen is this dichotomy, laterites versus sulfides, and where pricing is headed, and whether there'll be that bifurcation that Andrew Forrest in Australia has been kind of asking. So what is your view on the nickel market right now? Is this price level realistic moving forward? Will we see that bifurcation in price?
I mean, I think it's important to mention that nickel prices have actually also headed up 25% from the trough. So the pressure on nickel producers is perhaps not as significant as it was maybe 2 or 3 months ago. And, I noticed that a lot of those producers that were considering putting large operations in care and maintenance appear to have moved back from that. So, I think this price that we're at currently is a slightly more sustainable price. But there's no getting away from the fact that we are seeing a hell of a lot of new capacity going on in Indonesia. And it's going to be a very interesting one. I must say the moves by the US on the Section 301 tariffs, I think for me make it more likely that there will be a bit bifurcation in price, that there will be a price for nickel in the Western world and a price for nickel in China. And I will also note that Benchmark Mineral Intelligence, which is one of the sort of core players in the battery raw material space, have actually introduced a new environmentally friendly nickel price. So they produce two nickel prices going forward. And I think that could be a very interesting development. So we'll wait and see. I mean, I think it'll take a few years for those sort of movements to be sort of taken up by the industry. Certainly the Western industry is crying out for that sort of development. And I think there is now a recognition certainly in the US and to some extent in Europe, that we need to diversify supply away from China. And, however much Western companies invest in Indonesia, they're mostly doing so with Chinese partners. So those are not independent nickel suppliers. And I think that, me personally, the Indonesian developments concern me from an ESG point of view, particularly from an environmental point of view, but also from a social point of view. They're very, very carbon intensive. It's a seismically active part of the world. You're stripping a lot of rainforest. A lot of this waste material is just running off into the sea around Indonesia. And I like to see more environmentally friendly solutions from the industry. And that doesn't mean that laterite is bad. I know a number of companies that are working on hydrometallurgical developments for laterite, which would be much more environmentally friendly than the current pyrometallurgical work that's going on. But I'd also like to see more investment from the Western world in these sulfide assets, which are an order of magnitude less carbon intensive to process. And I think it's important that we go that way. And if that requires two-tier pricing, then fine, we'll just have to have two-tier pricing. But I do feel that, the focus from the auto companies on lowering prices has the potential to really bounce back in terms of what we're trying to do. What are we trying to do with the energy transition? It's lower carbon intensity. Well, there's no point in buying nickel that has a really high carbon intensity. It's just daft. It doesn't make sense. So I would like to see some sort of reversal of that trend.
So you referenced the states in the bill. I'm not familiar with the bill, but do you think that's where it comes from? Is it essentially the governments that you think are going to be the driver of this price difference? Or do you think it'll come from the senior companies? Like, the reason why I say this is because just like Sumitomo, a number of the Japanese companies have invested in not necessarily sulfide projects, but some projects in Canada that are would definitely be on the cleaner side. So do you who do you think is the main driver of this cleaner nickel?
I mean, I don't think the US government, the 301 tariffs aimed at making the nickel cleaner. I think they're aimed at safeguarding the US supply chain. So I don't think the Biden and prior to that Trump administrations really cared about Indonesian nickel versus Canadian or Brazilian nickel. They were more worried about safeguarding the US supply chain. But I think perhaps maybe in mining terms, a byproduct credit of that is that we will develop this sort of two-tier nickel market, because there will have to be one price for the US and potentially for Europe, and one price for China. And nickel with a high degree of Chinese involvement is not going to be permissible into the US market going forward. And if that's the case, then we have to develop more supplies, from the West. So I think the governments will be the major drivers. Yes, we have seen investment by some Japanese companies into early stage sulfide projects in Brazil and Canada, but we've also seen investment from those similar companies into laterite projects. So I think they're just diversifying their supply chain. I mean, realistically, the big mover and shaker on this is the auto industry. Are the auto industry prepared to buy nickel at a higher price if it's more environmentally friendly? And so far, the answer has been a resounding no. So, the only way this is likely to come through is if the government sponsor it and, require it going forward. Industry has proven that it has very little interest in pushing this forward, apart from obviously, the managements of mining companies developing these nickel assets. And fair to say, actually, this is an issue in manganese as well, and in graphite. We do this. This is more than just an issue in nickel.
This doesn't have to be metal specific, but what do you think about the argument of security of supply? Like, it's been used in whether it was lithium early on, definitely nickel, now. Security supply, countries rushing to, secure these battery metals for their own supply chains. Yet there does seemingly be that reach for whatever's cheapest. So how do you view the argument that security of supply is going to be something moving forward, especially with, I guess, the breaking or the divide between East and West?
I mean, I think that certainly the pandemic brought forward the fact that maybe we've gone a little bit wrong in terms of just-in-time inventories and the global supply chain, and we need to have more regionalized supply to a percentage level. So I think there's justification in that. There's a definite view, I think, in the US that the US does not want to be beholden to China really for any of its supply going forward. And I'm not a geopolitical analyst, so I'm not going to get into that level of detail, but I do think it's going to be very difficult. And, I wrote an article on LinkedIn when the 301 tariff was published last week, basically saying, look, by imposing these tariffs on Chinese material and not putting any holidays on apart from in graphite, you're effectively making it more expensive to manufacture batteries in the US and more expensive to manufacture EVs in the US. So if you want, your EV industry to be competitive, then you're going the wrong way about it. And realistically, there has to be a mixture between the carrot and the stick approach. And to be fair, the US has extended quite a lot of carrots as well. I'm not totally down on the US, but I do think that, not putting a 2-year payment holiday in place is effectively putting an awful lot of pressure on the supply chain. And I'm not convinced that the supply chain can step up to the plate within the next 3 or 4 years. So you're taking the chance of pushing consumers away from the EV event for the next 4 or 5 years in order to try and force development of new supplies in North America and Europe to some extent. And the other issue about that is that it's all very well to force development of new supplies in North America. But if that's the case, then you've got to improve the permitting situation, because at the moment it takes between 10 and 15 years to build a new mine project in North America, well, in the US in particular. And in places like Australia and in Canada, Australia, I'll say, and maybe Brazil and Africa, you can build a new mine in 3 to 5 years. So, if you genuinely want the US industry to step up to the plate, you've got to make it easier for that to happen. And at the moment, we know that we need more power, but it takes 10 years to build an interconnector, let alone a mining project. So, you've got to do something about the planning situation in the US if you want to put in this Section 301 tariff situation as well. So it's got to be joined up. You can't just go in and whack in these tariffs and not improve the planning situation, because otherwise there's no way that these assets can be built in 2 or 3 years. They can't even be built in 10 years from most of them.
And this is based off experience. This is not off data or anything, but the people I know that have sort of taken a step towards the EVs have gone for hybrids, not plug-in hybrids, but hybrids. And what I've seen from it is that, and it's a couple brands in particular, they've had problems both on the electrical side, the battery side of it, and on the internal combustion side of it. And my question for you is whether you think, if indeed there's a large percentage of people buying hybrids, whether it's sort of a ticking time bomb in terms of the complexity and potential problems, rather than making the jump to the battery EVs.
Well, I mean, the hybrid, so let's just take a step back and talk a little bit about the different technologies. So there's hybrid electric vehicles like the sort of Toyota Prius, which was the setter in that area. And then you've got the plug-in hybrid, so PHEV, which is effectively half and half. And then you've obviously got the BEV like Tesla makes, which is entirely electric. Now, just to stand back, and most hybrid electric vehicles don't even have lithium-ion batteries. So most hybrid vehicles use a nickel metal hydride battery. So that's a completely different sort of solution. And they also effectively run 2 drivetrains. Then the idea behind the plug-in hybrid is, well, we can't get to a situation where we go BEV immediately. So let's have this stepping stone. And actually that made sense to a lot of people in the industry. But it didn't make sense to European politicians who wanted to go all the way towards BEVs. So actually, plug-in hybrids grew very rapidly in Europe in the sort of 2018, 2019 period. And then the European Union started to clamp down on them and said, well, you can't run plug-in hybrids. We're only going to subsidize BEVs. And PHEVs basically got a big knockback from that in Europe and the US. But what we've seen recently is plug-in hybrids getting enormous market share in China. So in some months, up to 40% of electric vehicle sales in China are plug-in hybrids. And that's happened over the last 12 to 18 months. But the difference between a Chinese plug-in hybrid and a European or US plug-in hybrid is the size of the battery. The size of the battery is about probably a third to 50% bigger in China than it is in Europe or the US. And that makes for a bigger range. So you've got plug-in hybrids in China with a 70 to 100 mile electric range, whereas it's much shorter in Europe and the US. And I only say that because it makes the plug-in hybrid a much more usable vehicle, because if you're only commuting, say, 5 or 10 miles for your commute, you can use it for the whole week before you have to recharge it. Whereas in Europe and the US, our plug-in hybrids, they run much shorter ranges. So it's not such a usable vehicle. So we are seeing a return of hybrids and plug-in hybrids, because the other issue that we're struggling with here in the Western world is that our EVs are just too damn expensive. In Europe, the median price for an ICE vehicle is around about £15,000. I can count probably one electric vehicle, like a proper electric vehicle, BEV, that sells for less than £20,000 in the European market. And it's a similar situation in the US. I mean, I think the last I saw, the Toyota Camry was the best-selling vehicle in the US. I think that's what, $18,000 new. But there are no EVs selling at that sort of price, probably even double that sort of price in the US market. So, the issue that we're struggling with really is, one, range, but two, this big issue that we're not selling EVs at the right price point in the Western world. Whereas in China, they sell EVs at all price points. So, you have $10,000 EVs, you have $15,000, $20,000, but you also have your, $100,000, $120,000 EVs as well. So, we in the Western world, I think we haven't gone the right way in EVs. They're still a luxury vehicle, whereas in China, they're a mass market vehicle.
And so how do you remedy that? Because in China, and I'm just guessing here, that most of that is subsidized by the government. And
you say that. I mean, it's really interesting. I mean, all Western commentators, or a lot of Western commentators, say, Chinese EVs subsidized by the government. I'd love to know where people get that information from, because there's a lot of hearsay around, but there's very little actual evidence. I mean, if you look at, for instance, the subsidy paid out to the Chinese government, which is effectively a credit on sales, that's effectively a subsidy to the consumer. It's paid to the car company rather than directly to the consumer. But there's very little additional evidence of subsidies by the Chinese government to the car companies. The reason the car companies are so far ahead is because they have been looking at EVs and nothing else for the last 15 years. So they are 10 years ahead in terms of technology than any Western car company apart from Tesla. And Tesla went slightly off track initially by focusing on the NCA chemistry and focusing on range rather than on mass market electric vehicles, which the Chinese focused on almost from the beginning. So that's why the Chinese are ahead. It's not because of subsidies, it's because they've been doing nothing but investing in electric vehicles for the last 15 years while we were worried about diesel and petrol and everything else.
Well, I think the natural case why, because I guess I group subsidy in with, not having much environmental policy, bringing in stuff like Indonesian nickel, like we were talking about, because it's cheaper and it's right there. So your cost. And so the reflective side is like, how do you do it in North America then? Because we just talked about how you said, well, the nickel price is going to have to go up to incentivize buying cleaner nickel, putting these cleaner nickel mines into production. So to me, I don't know how you do it in the Western world without some sort of incentive from the government, which I would say is just, it's just how it comes out of the consumer's pocket. Do I pay it at the vehicle price, or do I pay it to the government through taxes?
I mean, it's got to be a government incentive, because the problem in the US and the Western world is some costs are just too high. I mean, labor costs, for instance. I mean, it's even worse for the US automakers. Labor costs went up this year again, and they went up last year. So, you do have a really big problem in the Western world. And, I think what is coming for the West in the next 5 years with the Chinese is exactly what happened with the Koreans in the 70s and with the Japanese, maybe the Koreans in the 80s and the Japanese in the 70s. Because they could just do it cheaper. They can just do it cheaper than the incumbents. And, there's a reason that the Toyota Camry is the lowest cost vehicle in the US. It's because Toyota can make it cheaper than GM can for a comparable vehicle, or Ford. So, I think I can understand that the US government is trying to promote the auto industry. I can understand that the European government is trying to promote the auto industry. But at the end of the day, if you can't beat them, join them. So, maybe the situation is to get the Chinese to produce in the US using US workers and benefit from it that way, rather than the alternative. Now, I realize I opened up a huge political kettle of fish, and people are probably going to be throwing things at the screen and screaming at me. But, as a simple geologist, that seems to me to be the easiest answer here. But I think that we are going to otherwise have a situation whereby GM and Ford and Volkswagen and Mercedes and Stellantis and whatever are going to be insulated in our own markets from Chinese competition, but the Chinese are going to reign supreme in the rest of the world. I don't know how long that is viable for the governments to bail out the automakers for. We're already seeing, the Chinese start to dominate into Latin America. We've seen them start to dominate into Australia, into Africa, Eastern Europe, the rest of Asia. So, and they're going to be knocking out, certainly in the mass market area, the Japanese who've been slow to the party, the Europeans who've been slow to the party, and the Americans who've all been slow to the party. So, yeah, I don't know what the solution is. I don't get paid enough for that.
Well, I think, honestly, and this is just my opinion, but I just think that if people truly want to pursue, I guess, the electrification of the world, it's just going to come at a higher price. And it's going to put people's morality in terms of, if that is indeed what they want, they're going to have to pay a higher price to get it. Because, again, it's whether you pay a higher price for the car or you pay more taxes to the government, you're still paying more. So,
yeah, I think to some extent, I agree with you. I mean, I wrote a piece, a blog piece about 4 or 5 years ago when I first started, covering this industry, saying that I didn't think that the consumer realized how inflationary the energy transition was going to be. And I think the consumer now is starting to realize how inflationary. And it's very interesting that as soon as the consumer has started to realize how inflationary the ET is, the politicians are backing away from it. So, how much longer do we go on in the current situation? Do politicians back away from the energy transition altogether? We go back to the status quo and let half of the Pacific sink? Or do, they just say, well, you're just going to have to buckle down and weather it for the next 10 years or so? We have a situation whereby we're basically in a high inflation decade. And my gut feeling is we're going to be in a high inflation decade. But, for us as the consumer, the man on the street, it doesn't make it any easier even understanding what's going on. But I think, everything is going to be inflationary. And, it's not just electric vehicles. It's electrification of the grid. It's getting rid of gas power, coal power, bringing in nuclear, increasing interconnectivity, increasing storage. All of this is expensive, and it uses raw materials which have been underinvested for 15, 20 years and are expensive to get out of the ground and that are expensive to develop. Great news for the mining industry, of course. Just got to get your right commodity.
In our last conversation, you mentioned that in your view, graphite was next. And I believe in terms of being in a bull market for pricing. How do you feel about graphite today?
Well, I was wrong, wasn't I?
Well,
I still feel that graphite, is one of those industries that is really badly understood by policymakers and by investors. Graphite equities have really only gone in one direction since the last time we spoke. Graphite prices have also only gone in one direction. And, we talked about nickel. I mean, graphite is another one of those industries which really needs government protection. Because it's very, very difficult. It's actually impossible to build any new graphite projects with prices at the level that they're currently at. So, we need to see government funds coming in because the equity markets are closed to these companies and probably the debt markets are largely closed to these companies. So if you want to build a viable midstream and even upstream graphite supply chain in the US or North America, in Western Europe, then governments have to come in.
Why is that? Are we just talking about that these are sub-economic and that's why they need the sort of subsidy or a push to go ahead?
Well, it's because what happened last year is we saw a big investment by the Chinese in synthetic graphite, which really pushed processed natural graphite prices down. So spherical graphite prices in China absolutely dived. which drove down graphite concentrate prices as well. And as a result of that, the equity market follows these Chinese graphite prices, rightly or wrongly. So the market valuations of most of the graphite industry just dropped through the floor. So you now have a situation that if you want to raise money, most of these companies have got projects of the order of 500 or 600 million capex, and they've got market caps of the order of 150 to 200 million capex. So it's not viable. And we actually saw, there's a couple of Australian companies. We saw the Australian government, provide grants and debt funding, low-cost debt funding for these companies. We've seen the US government make money available in the midstream, but not really in the upstream. And we need to see more money going into the upstream and the midstream in the Western world if we're going to get out of this. So graphite is still very much at risk. But from an equity standpoint, it's very difficult to invest for institutional investors. It's still there for the retail market, but it's very, very difficult to invest for institutional investors now because the companies are all too small for institutions to go in. So we really need to see some sort of very serious government support in this space. And the other area that's very much like that is the high purity manganese area, where again, you're talking about capex of 600, 700, 800 million and companies with market values below 100 million for the Western world projects. So it's impossible for those companies to raise equity. They have to get government support if any of those projects are going to go ahead. And between graphite and high purity manganese, China is 90% of the market. So if you are serious about security of supply, these projects all need to be supported, really.
In terms of the best value in the sector, if you were to pick one battery material out there, where should investor be looking, do you think, the rest of 2024, maybe into 2025?
That's a really difficult one. Obviously, if we were talking a year ago, I would have said lithium. I'm less certain on lithium. I think there is money to be made in lithium, but it's going to be very cyclical. I wouldn't necessarily sit here and say, well, lithium prices are going to average materially above where they are for the rest of 2024. In terms of, if you put money in and getting money out on the other side, I would probably say nickel. I would obviously not today because there's been a bit of fun and games in New Caledonia over the weekend and nickel prices have reefed. But if you took where we were in nickel last week and maybe where we will be in nickel going forward, I would say probably nickel. I'd like to say graphite and high purity manganese because, those sectors are really needed. But if you're looking on a 6 to 12 month basis, I don't know. And then, lithium is going to be a trading environment. Again, if you say 3 months, well, maybe it would be lithium. But if you said 12 months, I'm not so sure. I'm trying not to sit on the fence here, but it really is a very difficult environment. Really, it's not strictly a battery material, but they are used in batteries. Maybe copper and aluminium would be the spaces that you'd want to look into. But in terms of the battery materials themselves, it's been a rough ride, and it's likely to continue to be quite a difficult ride over the next little while. I'd like to say that I think prices will go higher from here. I certainly believe they will in graphite, and I think that high purity manganese prices will go higher. So in a convoluted way, I'm going to go for graphite and high purity manganese.
Battery Materials Review offers both free and paid content. Can you please tell us more about what you have to offer and where they can find it?
Sure. So their website is batterymaterialsreview.com, and we have our yearbook, which is free content, which came out at the beginning of the year, which just gives an idea of the current state of the market, as it were, in battery raw materials and the battery supply chain, even going downstream as well. And then Battery Materials Review is really a sort of educational product for investors new to the space. It's also a market intelligent product for companies and more experienced investors in the space. We put out a 30-odd page newsletter every month, focusing on what we see as the more important aspects of the industry, the news flow that's moving prices, likely to move stock prices, likely to move commodity prices. I think it's a really fun read, insofar as battery materials can be fun. But I think there's always something new happening in this sector, and it's always changing how we think about the sector. And I think it's very important to think globally, to look globally, to look at different demand markets, and to understand what's happening downstream in the stationary storage and in the electric vehicle market, because that impacts how battery raw material prices are behaving on a sort of day-to-day, month-to-month basis.
Matt, it's been an absolute pleasure today. Always enjoy the conversation. Thank you for coming on.
Thanks a lot. Thanks for the invitation.